Welcome back, Wealth Builders. Thanks for joining. Today, we're going to discuss whether or not you should invest in stocks. Before doing so, please take the time to like and subscribe. It's greatly appreciated, and it helps me make more videos just like this one. As a reminder, I'm not a financial planner, but hopefully you'll allow me to share some financial education with you. Anyone can build wealth over the long term. So, Wealth Builders, should you invest in stock? Heck yeah, you should invest in stocks. Stocks are one of the main vehicles wealth builders have to build wealth over the long term. So you might be wondering, hey Fabian, why should I watch the rest of this video if you just confirmed that I should invest in stocks? Well, because investing in stocks is not as easy as it sounds. Investing in stocks comes with risk. And depending on what your goals are, you may want to invest in certain industries or types of companies. You may have a specific investment philosophy in mind and have a specific risk tolerance, which should match what type of stocks you buy. Some companies have more risk than others. How do you pick the right ones? With buying stocks, it's important to understand what you're buying. Okay, so quickly, let's go over what a stock is. Think of your favorite brand or company that has stock outstanding. We all have a favorite brand or company: Amazon, Tesla, Berkshire Hathaway. Let's use Amazon as an example, because pretty much everyone has an Amazon account. Now, I'm not intending to make a history lesson about Amazon or tell you that Amazon's the best company out there. I'm just using Amazon because it's a very relatable company that everyone is familiar with. So it's just an easy example to use. Do I own Amazon stock? Yes, I do. Although I talk a lot about Amazon and I kind of poke fun of it a lot in some of my videos, I actually really like Amazon as an organization. And yeah, it's not a perfect company and there's some refining that they need to do with their employee relations. But overall, it's a sound business model that has been very disruptive. Let's take a look at when Amazon first got started. Amazon went public in May of 97, and the share price was $18 per share. Now, what that means is that Amazon as a company worked with investment banks. Think JP Morgan Chase, Goldman Sachs, B of A Securities, to offer stock for sale for the first time. This initial sale raised capital, money, so that Amazon could grow its business. This was the initial public offering, or IPO. So this is when stocks began to trade freely among retail investors. Retail investors are basically you and me. As a result, investors that own stock become part owners of the company. Amazon used this injection of money or capital to fuel its continued growth. Amazon went from selling books online to selling just about anything and leveraging millions of suppliers and sellers. Business has expanded to artificial intelligence, cloud services, autonomous vehicles, and further e-commerce expansion. Now, as of today, the stock trades at just over $3,100. I hate to do this to you, but it's kind of fun to do. Let's pretend you would have invested $1,000 in Amazon when it went public in 1997. What amount would it have grown to today? Well, if you would have held on to it through 2020, it would be worth just a cool $1.2 million. Now, here's what you got to keep in mind. Probably shouldn't have gone there. I had to do it. I'm sorry. Now, here's what you've got to keep in mind. It's important to adjust your expectations. Not every company that goes public will be a success. Some will be losers. Amazon is unique in that it was able to disrupt consumer shopping habits and expand into other areas of business and technology. Apple did the same thing with the introduction of the iPhone. The iPhone changed the cell phone market permanently and made it easier for people to embrace social media. There are not very many companies that are able to change consumer behavior or habit. I'm not advocating for you to invest in every IPO, and each IPO should be evaluated carefully based on conducting financial analysis and evaluating future earnings and profit potential. I'm also not saying that you shouldn't invest in IPOs, I'm just saying that not all IPOs are going to be Amazon. So, when you evaluate what stocks to buy, it is important that you perform research to see how successful the company is currently performing and what is the potential that it will continue to grow and improve. Questions you should ask yourself when evaluating whether you should buy a stock is whether the company is profitable, or at a minimum, what the roadmap to profitability looks like. What is the revenue for the last 3 years? Is it going up or down? At what rate is it going up or down? What are the costs? Are they going up or down? You should be cautious of a company that has not been consistent in its ability to increase income and sales while increasing costs erratically. Income statements, balance sheets, annual reports, and growth potential should be analyzed carefully. How you look at and evaluate a company in the growth stages of its business lifecycle versus an established mature company is going to be different. This brings me to my next point. Teaching you how to properly evaluate a company, conducting financial analysis, would take hours of study and training. If you're someone that does not have this training or does not have the time to invest in education and training, well, I've got a simpler alternative. I'm not discouraging you from learning how to properly evaluate a company's financial statements. I think you should, because it will only help you build wealth and make more informed decisions. I'm just saying that some people may not want to invest years of study and education to learn how to do this. Let's not forget about the amount of time it takes to conduct the research to find which companies to compare against each other. If you're one of those people that wants to save time or just not spend the time doing this, well then that's why I'm here, Wealth Builders. So I'd like to bring up something that we've all experienced recently. When the stock market crashed in March of 2020, it was easy to pick stocks. They were all down. Most stocks you picked back then have increased since then. But how do you pick stocks now? How do you pick stocks in an environment when most of the stocks have recovered or increased? So here's my alternative, Wealth Builders. Consider investing in ETFs. So what are ETFs, or exchange traded funds, you may ask? Well, they're similar to mutual funds in that they pool investor resources together to buy stocks. The price of the ETF share price is derived from the value of the stocks held within the exchange traded funds. The other thing that's pretty cool about exchange traded funds is that they're traded on major exchanges, as the name implies. And they are traded throughout the day, as opposed to mutual funds, which are traded at the beginning and end of day. Let's say an unexpected expense or emergency comes up beyond what savings you had. Let's say you have to go to the doctor, or your car breaks down. Having an ETF will easily let you find a buyer in the open market for the shares that you need to sell. Here's another reason why I love ETFs. ETFs will offer you something a single stock can't. In buying an ETF share, you gain ownership exposure into several companies. Exchange-traded funds typically invest in several companies, reducing the risk of owning just one company. If one stock goes down within the fund, the remaining stocks could go up to offset the drop. Essentially, by investing in an ETF, you'll gain diversification. Now, let's look at Vanguard Total Stock Market Index Fund, ticker symbol VTI. I'm not recommending that you should invest in VTI because, well, I'm not licensed to do so or licensed to give investing advice. I'm just using this ETF as an example to illustrate the point because it's representative of the US stock market. As of the date of this video, one share sells for $190. Some of the top holdings are Apple, Microsoft, Facebook, Alphabet, Berkshire Hathaway, Johnson & Johnson, Procter & Gamble, Visa, Nvidia. Let's say you're just starting off in your investment journey. If you just wanted to buy one share of Amazon, you would have to wait several weeks or months to invest. Because again, it's trading for $3,100. Here's what is awesome about ETFs. If you have $190, you could start today and again be closer to having a diversified portfolio. Here's another reason why exchange traded funds are awesome. Firms like Vanguard and BlackRock offer a wide variety of ETFs for different industries and reasons, or investment philosophies. You can pick technology ETFs, healthcare, energy, real estate, value, growth, life cycle, international exposure, and so on. All while offering funds at low fees, which can be helpful in increasing your overall return. Just watch out for some of the actively managed ETFs because those may charge a higher expense ratio, which will eat into your profits. Again, if you're someone who doesn't want to spend the time or have the time to conduct research on individual stocks, then ETFs are a great way for you to invest in stocks. Because by investing in ETFs, you're going to gain exposure to industries or the total stock market, depending on which ETF you select. And because the ETF has several stocks that are included within the ETF, you'll be more diversified. Auto investment plans could be set up, dollar cost averaging can also be applied to help you build wealth over time. Now, if you're wondering, well, what does that look like? How do I know you're telling the truth, Fabian? That over the long term, the stock market goes up and stocks go up. How do I know that? The value of successful companies goes up, even when you include things like the Great Depression, major wars, conflict, recessions, presidential elections. The market increases over the long term. There may be disruptions here or there, right? I mean, nothing's going to be perfect all the time, but those are just buying opportunities. When the market goes down, buy more shares if you can, because that's when they go on sale. That's when you should buy more. Now let's revisit why you clicked on this video in the first place. Should you invest in stock? Heck yeah, you should invest in stocks. Regardless of how much you have to invest, ETFs are an investment vehicle that will help you build wealth and a diversified portfolio while minimizing fees. You won't have direct ownership in the stock, but you will own shares of the ETF, which derive its value from the stocks within the ETF. So wealth builders, has this changed your perspective on whether or not you should invest in stocks? Are you now considering ETFs? Please comment below. Was the information helpful in getting you started today rather than next year? Thanks again for stopping by, Wealth Builders. If you learned something new, please hit like and subscribe. Little Piggy will greatly appreciate it if you do. I hope you have a great day.